Today, news came out that SoFi, which stands for Social Finance, is going public via SPAC. In particular, Chamath Palihapitiya's SPAC, IPOE Stock, is bringing SoFi stock public. The merger is expected to close in the first quarter of 2021. So in this video, we're doing a deep analysis in terms of SoFi stock, in terms of thinking about what's the business, what could that be worth over time, and what could IPOE, or whatever ticker it ultimately changes into, could be worth in the years ahead. So what is SoFi? It aims to be the winner in a winner-take-most fintech arena that's seeking to disrupt the trillion-dollar financial system. The trillion-dollar financial marketplace is not only in the US, but I would argue globally in time. Now, IPOE stock did jump pretty dramatically today. Today was the news that it officially came out. I don't make these videos on the speculation. I always wait for the news to dive in, because otherwise it's just conjecture. Here you can actually see the details, what's actually driving this business. And the price of IPOE has gone to nearly $20 a share. I think in overnight trading it's around $20 a share. And this is Chamath's, why did it go up? This is Chamath's one of his single largest investments of all time. And SoFi is a fast-growing disruptor. Now, it's not the first video that I've done on various different Chamath SPACs or SPACs in general. I'll leave a note or a link below in the description so you can see all the different videos I've done over time. In particular, I've done a video on Open Door and Clover, two of Chamath's other SPACs that you can check out, that does a similar deep dive into what are those businesses, what's driving them, what could they be worth, a valuation range over time. What do I think? And this is the format where I give you sort of a 1-2 minute download first on what do I think of the business, and then do the deep dive. What do I think of SoFi? I think they're an interesting business model. You got a couple of different pieces that were sort of put together. Very fast growth potential, definitely potential for disruption. Despite the recent run up, if management delivers on the expectations that I will be showing a little bit later towards the end of this video, IPOE does have the potential to double from here. But once again, that depends on their execution, delivering on very fast growth, as well as sizable profit margins in the future. But I'll cover that at full extent of what I think about the valuation, the detail behind it at the end of this video. Until then, let me do a quick 10-second plug, but before we do a quick dive into SoFi, which is that my name is Daniel, you're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find you exceptional companies and unrivaled investments. If you enjoy learning about potential multi-baggers, the types of stocks that can go up hundreds or thousands of %, make sure you subscribe. If you're already a subscriber, hit that thumbs up. It does help people know, hey, this video is probably worth watching. And if you want to follow my personal journey in terms of what are the potential multi-baggers that I'm buying, go to unrivaledinvesting.com, click on Journey. Now let's do that detailed dive into SoFi that many of you want to hear about. What's actually going to drive the stock over time beyond the short-term hype. So what is SoFi? Their roots actually started off providing student loans, originating them, but now they've actually branched off into several different segments. And you can see the different segments here. You have lending, which includes several different loan type products. They have the Galileo technology platform, which includes a 1/6 ownership of Apex Clearing. We won't talk much about Apex here, but Galileo is of interest significantly, and we'll talk about that in a bit, as well as financial services, where it's a whole bunch of traditional financial products that you would expect to see, and that several companies have sort of offered. So traditional financing packages, a very interesting tech platform, and very traditional financial services that you'd expect. Let's go into each one of these. So what is SoFi? When you look at it today, it's going to be very different from what it could be in the future. At this point, most of their business comes from their lending platform, which is around 83% of their revenue right now. Currently, around 17% of their revenue is this tech platform, or Galileo, but they're really expecting them to these other businesses, including financial services, to grow in their own right over time. And keep in mind, financial services, that's like credit card, savings account, investment account, budgeting, small business loans, and how that compares versus traditional lending like student loans, personal loans, home loans. You can see all these different types of buckets. And so, the business versus a home loan and let's say student loans now should be much more diversified in the future, where this sort of tech platform is a key part of the business. And we'll go through each of these different segments, as we go through this video. So, what the core value proposition that they're talking about is being a one-stop shop. And, this is an interesting, sort of diagram where, here's this, it's effectively saying, look, we're everything on an app. You can access it all just by going here. And they're targeting, keep in mind, they're targeting the high income, good credit, they think underserved or poorly served segment, where traditional banks just aren't cutting it on their service for, let's say, a young married couple that's one's a doctor, one's a lawyer, and they don't spend any time thinking about their own finances, and they want to know, like, hey, can we afford a house? Can we afford to have kids? But it's this higher end of the market, good income, good credit that they're targeting at this point. So higher end, good income. Hey, what if we could have a one-stop shop for them? Because that could probably be worth a lot. So they're clearly not addressing the subprime market or any other markets. It's let's focus on this top tier market here. And what's interesting is they've shown in the last 24 months an ability to launch new products very quickly. Savings product, Relay, which is effectively a budgeting app, investing product, allowing people to invest in various different ETFs or stocks, fractional trading, home loans, in-school loans, credit card, and SoFi Rewards, all of this on their app within very short order. So that would suggest that they're doing something right. In particular, the idea that, hey, they can iterate quickly. And honestly, if you're trying to disrupt an industry that is literally hundreds of years old, being able to iterate quickly could be a distinct advantage. But you're going to have to do a lot more than that ultimately to disrupt a multi-trillion-dollar apple cart. It's interesting, though, like looking at this app, how they call out like, hey, you've earned, it's very hard to read, you've earned 60 SoFi points. Wow, 4 days in a row you've logged in. It's almost like they're gamifying, people's finances. Like, good job for logging in. You've grown your farm bills working out. Instead, it's your own savings account and checking it out over time. So, but, it's an interesting idea. Like, hey, what if you start off with a savings account, and then when you reach that stage in your life and you want a home loan, they could be that point, or they help you refinance your student debt, and then you have your savings account, and then you're looking at the home loan, and then maybe you need to start thinking about various different credit cards, start thinking about budgeting, start thinking about investing. It could all be in one place. Now, sort of what's the advantage of doing that, and why are they doing that? At the end of the day, the goal is to become like this super finance app, the financial super app. And, they say, look, 80% of consumers cite inadequate one-stop shops as the reason why they have more than one account. So it's interesting that they show like most people, the vast majority of people, do not have all their finances at one bank. They have it. It's a good first world problem to have, where it's like, hey, like this bank isn't satisfying my needs, so I'm going to need to be at this bank and this bank as well. One's going to be for my credit card, one's going to be for savings account, one's going to be for my investing. And it gets spread out because of the flexibility, because of the different services, products, the different fee structure. And they're like, look, what if we could have the best platform for it all? We could be the super app, the financial super app of this all. They're saying, look, SoFi is the only company providing this solution today in one app. They're saying, oh, look, you don't need to be like one of these many consumers that are growing to other banks to look for it. We can be something special. Why? Why does this make it special? And having a one-stop shop for your various needs, whether or not it's investing or personal loan, credit cards, home loans, student loans, savings account, it results in a lower customer acquisition cost for that second product. So you start off, let's say, with a savings account, but then you're thinking about a home loan or you're thinking about a personal loan. At that point, because you already have a positive association with SoFi, you're more likely to go with them. Oh, it's already in my app. It's easier to track everything. It's all, boop, you just click on another part and it's right there. I don't have to go through the hassle. And I had such a favorable experience, let's say, with my savings account. Maybe now this is a place to go for my personal loan. So now they don't have to spend a lot of money acquiring you as a new customer. Hey, you're already a customer. You're just learning about the different products they're offering. So the faster they iterate on new products, the more products they have, and the more of a value proposition they're ultimately offering the end consumer. So if you have a lower customer acquisition cost, so effectively cross-selling is the key word. I've heard Wells Fargo talk about cross-selling for years and years, but here it is, the same theme sort of gets talked about in a different way. And in this case, they're saying it's lower customer acquisition cost. They're saying, look, if you have a lower customer acquisition cost, it can result in much higher margins over time. For example, if you start off with this product, which is the money-only product, or let's say a savings account, and then you get a personal loan, well, here's your variable profit in both cases, but there's a cost to acquire this customer. They say member, but acquire this customer. $40 to acquire this customer results in $85 profit. For a personal loan, to sort of advertise out like, hey, we're good for personal loans, it would cost $825 to sort of lock them in. Now, what if you're already here and you're already happy with your money product and you're still thinking about that personal loan? Then instead of paying $825 for SoFi in terms of acquiring you as a customer, they don't have to pay that at all because you're going to them saying, hey, I'm interested in your personal loan. Now their margin goes from $938 to $1,800. Now, if you compare the two where, hey, this is effectively two separate customers where they had acquired each versus one customer that was successfully cross-sold, the profit margin difference is about 80% higher. The difference between $1,000 and $1,800, more than $1,800. That's a huge difference for cross-selling, and that's why it becomes so important, one, to iterate on multiple products, but you got to make sure you have a product that consumers like, because if you have a product consumers like, they'll stick with you, and then they'll check out your other products and be like, hey, what do you got? I'm interested in personal loan, I'm interested in credit card, I'm interested in a home loan. So more cross-selling equals lower customer acquisition cost, which in this example results in 80% greater profits. That's huge. That can be a game changer in a financial industry if you're able to cross-sell, let's say, better than everyone else. So has this actually started to play out where they're able to cross-sell so much better than everyone else? And here it is, their home loan segment is crushing it, where they call out that 65% of home loans come from existing members. That's incredible. Here they talk about it in the third quarter alone. They had $30 million in revenue on $1 million in acquisition marketing expense. That's an incredible return on investment. $1 million in marketing expense, and they're able to get $30 million in incremental revenue from these existing members that wanted to get a home loan. That's incredible cross-selling, where their customers know, hey, if I need a home loan, this is I'm gonna go with SoFi. I've been pleased with their savings product. Why not check it out? And this creates an opportunity to do the same in personal loans, investing, school loans, where you create this cross-selling sort of virtuous cycle of getting very high margins in each of these segments. But it doesn't stop there in terms of the business model. You don't just get super high margins and stop. That's where having a growth mindset is so critical, because what do you do with the profits? And the greater the profits, the more they reinvest in the business. Chamath, on the call, he talked about how he mentioned AWS a couple of times, or Amazon, about reinvesting in the business. And so, you enhance your value proposition, and management articulated pretty much the same thing. How do you reinvest? How do you increase your value proposition? Well, you make it easier to do all sorts of business lines online via app. You make it super fast. You make it so that you can easily do it on the weekends. People don't like the CEO called out how people don't like waiting in lines. People don't like waiting in lines to go to the ATM. People don't like waiting in lines to get money at a bank. They want things to be super fast. If you need to pay off a loan or credit card, they want you to be able to do it that day, that minute. Why not make a seamless, super fast process versus these legacy players, legacy systems that are generally slow, incumbents that aren't moving, that aren't disrupting? Do they have the potential to sort of disrupt a multi-trillion-dollar market? And you take these profits and you reinvest them in unprofitable lines, and we'll sort of show that in a second, so that way you can create that flywheel and further enhance it, where customers are like, oh yeah, I started off with savings, now I'm in the home loan, now I'm using their credit cards, now I'm doing their investing, everything becomes SoFi, and just imagine the margins that they're getting on that because they're not spending anything to acquire the customer beyond that first product. So, and then there's more that you can do, not only to expand product lines, you can enhance your value proposition where, SoFi can say like, look, we're going to lower our interest rates, lower our fees, because now we're so much more profitable in terms of the customer acquisition cost. We don't have to have this level of interest rate. Now we can lower this interest rate significantly. We're way more competitive against all these other players. So now we can take share and grow faster. And that's ideally what you would see with their lending figures over time. And that's the part of the reason why like you see this whole flywheel of them create new product lines, invest to make it a better experience, and then lower the cost, so that way you grab more of the market share, even more people go into it. And fundamentally, this is what's driving this chart down here right below me, where I'm showing what's their adjusted revenue over the next few years, where they're thinking effectively it can go up by 6x in 5 years. And that's a lot. That's part of the reason why the stock's like, go up today. Like, people are pumped, people are excited, like, oh, hyper growth Chamath deal, let's dig into this is cool, let's just bid this up. So, I mean, this is part of the reason why, and there is validity to it. I get the appeal there. So let's actually ask ourselves, well, how do they actually make money? What's the business model here? Let's go through each of these segments, because so far we've sort of just been going on their primary segment, which is lending. So for lending, they're 100% originating and reselling the loans, putting them in a tricky position of sort of relying on outside capital, whether or not it's another bank or some sort of collateralized securities vehicle that's buying these loans. At the end of the day, it means you're relying on outside capital to originate and then sell it, because it's not staying on your balance sheet very long. If you have a problem where, let's say, someone's not willing to buy it, then it gets stuck on your balance sheet and it starts creating real problems for you. But I should call out, they are trying to get a national bank charter, which should lower their cost of funding over time, should make it possible for you to have, a great savings, deposit some money with them, and then they could start holding more of this on their balance sheet, have more interest income. So that's where they are with lending. Lending right now is primarily an origination business. You originate it and sell it at a profit, relying on outside parties, to effectively finance it and keep it on their balance sheet. So it needs to be good loans, but that's what they're targeting. They're targeting these sort of high-income younger folks that are up for using an app. So then you have Galileo, the technology platform. What are they doing there? And what's interesting is Galileo is a financial backbone to many neobanks, or these new sort of digital banks that are, or digital financial products or fintech apps that are disrupting various niches in the financial markets. You could see all the different logos here, like Robinhood and Chime and Blue Vine and Revolt, I think. I don't know how to pronounce that. So Chamath likens their Galileo segment to the AWS of fintech, where you're effectively converting a cost center, which is your technology stack, how do you run this, to building out all this tech, to an income center that becomes a business-to-business solution, where Robinhood needs them for their basic operations, and hey, they're going to have a multi-year agreement with SoFi where they're going to be paying them based on account and usage, and it'll just be a steady, very recurring revenue, very high margin business. So Galileo is a fantastic, high margin, fast growing, recurring revenue business. This is a gem of a business that's sort of the backbone behind these companies that are growing very quickly. And on that, here they say SoFi is responsible today for more than 90% of all the new account creation amongst all the neobanks in the United States. I think in particular they're talking about Galileo here, but they're showing that here it is, the total number of accounts that they're through their partners, through let's say the Robinhood partner, has grown from 25 million accounts at the end of fourth quarter 2019 to 50 million in the third quarter 2020. I mean, that is just incredible, exponential growth that they've been able to achieve, reflecting the critical infrastructure that they're providing to all these fintech apps and fintech partners. Now, this, so I've gone over lending, how they're making money. You originate the loans, then you sell it. I've gone over Galileo, which is, create a multi-year agreement with one of these fintech apps. They've already built out the tech, then they're effectively licensing it out and get a recurring revenue plus usage fees that scale as their businesses grow. And then this leaves their financial services segment, the third piece of the pie that we're talking about here. Financial services, that's investment. Relay, which is budgeting, money, which would be savings, Protect, which is their insurance, various different insurance products, credit cards, Lantern, which is like business loans and a financial site. But when you look at the actual financial contribution from the financial services segment, it's pretty de minimis relative to the big picture. Like they're saying 11 million in revenue versus 620 million in revenue in 2020. So it's a very small contributor, and it's a huge net loser in terms of the cost structure right now. Now, they're expecting that over time, by 2023, so several years of investment in this product, and this is where they're saying, hey, take the profits of their lending division, put it in other product lines like financial services, and then in time, you'll get, a satisfactory margin here. And that's what they're saying. In time, this could be a 47% margin, 500 million in profit versus 100 million in profit. Now, 100 million plus loss right now versus 500 million in contribution profit. So sort of like gross margin by 2025 for their financial services segment. And financial services, as I've alluded to up here, it covers a lot of different things. So it's not just isolating one given product. It's various different products. So what are my thoughts on valuation? I've covered all this stuff. There's a lot of different moving pieces. In this case, you can aggregate it because, management is sort of showing you like long term, they think they can get, to 2025. They're saying their contribution margin's 40%. Their adjusted EBITDA margin is 32% plus. So, you think optimized margin long term could be somewhere between 30 and let's say 40%, because this contribution margin should be like each incremental dollar of profit. That's what it's going to look like. So longer term, it could get to this level theoretically. So, I'm putting a range of margins, and keep in mind my margin assumptions here could be too high. And also take a step back. This is my value proposition to you. I'm going to have this sheet in the description of this video. You can click on it, download it, and play around with the assumptions yourself as you see fit. This is a hypothetical range of valuations. I like to have a logical framework, how I think about things. Of course, it can go a lot higher or a lot lower, but that's animal spirits. I like to have logic that drives my decisions on what am I buying, or what am I interested in buying, and why. What do I think about that risk reward? So when I look at this, currently it's just shy of 20 bucks, might even break 20 bucks tomorrow, who knows, which implies a current market cap of $17 billion based on the existing share count of nearly 900 million shares. And you look at this, and also, by the way, Chamath, as a sponsor, you get a couple % of the deal, and so here it is. This automatically makes the deal almost worthwhile when you see this dynamic. You get 2% of a $20 billion deal. That's a pretty penny. So 450 million in revenue in 2019. They're guided to 620 million revenue in 2020. That's about 38% growth from 2019 to 2020. Then what's the range of growth? I'm putting 40 to 57.8. This 57.8 is based on what they're penciling out here of 980. And by and large, this valuation range, the base and low are sort of my assumptions. The high is sort of using management's assumptions. So I tweaked how I usually look at this, where I put in 4 years, so that way it more closely matches what management's targeting. So you can see, for example, 2025 revenue of 3.669, and that's what they have for adjusted revenue in 2025. And then I say, what's the margin margins that people value this on. Not necessarily what's realized, but what's the optimized margins that people think this business could do and that it's ultimately valued on. And so I'm saying, 30% to 40% for that. So, it does, the initial smell test is, could this be interesting? Because you're penciling out pretty high growth and an interesting multiple. Slap on a growth rate in the years ahead. Their upside case, or what management thinks, is saying, look, 39%, nearly 40% CAGR over the next 5 years. Look, I want to be conservative, so maybe pencil out 25 to 30. Maybe I'm not being conservative enough. Maybe it should be 20% in the low side. Then what's the multiple, you're looking at in 2025 effectively? 20 to 35 times earnings multiple. Now, keep in mind, this is the reason why we're using what's the margins that they, not even that they realize at this point. This is the optimized margins that they're being valued on. Looking at that, this pencils out over 100% upside over the next 5 years if they deliver on management's targets, and it's being valued at even higher margins than what management think they could pencil out. They're penciling out 32% EBITDA margins. So I'm saying like 40% optimized margins. And once again, it's not sort of like for like, because EBITDA is different than operating income. Operating income is net of depreciation and amortization. And so here it is, I'm saying like the upside's 120% versus downsides of 45%. It's not the most crazy compelling risk reward, but I'll get into that in a second. So SoFi is looking to become the winner in a winner-take-most fintech disruption. That's how sort of Chamath has framed it. Like, hey, this could be one of the winners in the winner-take-most setup in finance, and finance is a multi-trillion-dollar market, and there's this huge potential to grow super fast. There's a good chance they do it. There's a good chance they successfully disrupt a multi-trillion-dollar market with all these different products. You get that flywheel going of lowering your fees, lowering your interest rates, getting more consumers that you cross-sell, higher margins, and the cycle just keeps going. There's a chance they don't. There's a chance that, over the next 5 years, it looks like this or even worse. Maybe they don't deliver on this. Maybe the margins are clearly a lot lower. That's sort of the downside scenario. Maybe what they've put together doesn't actually flow well together, and I'll get into that in a second. And maybe there's a chance they actually do even better than what management is penciling out here, because, and this is a key point that they call out, they do have the bank charter that they're applying for, and should likely, I would imagine, it goes through. In which case, their profitability by 2025 is, instead of 1.2 billion in EBITDA, could be like 1.5 billion. So like 25% even greater profitability, and that's part of the reason here I'm using that 40% margin. Is it's a nice uptick from the 32%, this 1.177 EBITDA profit that they're targeting. So saying like, hey, you get this bank charter, you get full credit for what you can do here. Why do you have higher margins with a bank charter? Well, you have a lower cost of capital. You don't have to worry about selling your loans at unfavorable terms. If you make a loan and then let's say the whole market freezes and you're not able to offload it easily, hey, you can just keep it on your balance sheet, get a good interest rate during that time period. And your cost of capital should be lower because you're collecting deposits, which generally you're getting a spread off of those deposits versus what you're loaning it at. So what are my thoughts as I look at this? I sort of talked about how I'm not crazy compelled on the current valuation, given that it has run up quite a bit, and I think the risk reward isn't as compelling. I'm going to share some of the exclusive thoughts that I usually save for Journey subscribers here. And normally, as I said, I would save these additional thoughts exclusively for Journey subscribers, but in a gesture of faith or goodwill, to many Chamath and fintech fans out there, I'll share a little bit more of my thoughts and sort of what's giving me reservations about this setup in terms of SoFi. So I have a few concerns. So first of all, lending, while it's nice to think you're just going to take a lot of share over time, the reality is lending is a commodity business where it's just capital being applied like, hey, I'm willing to offer you a loan, this person's willing to offer a loan. It's not super duper impressive. Like your home loan rates, as anyone that has a home out there, they'll know it's a very competitive process. It's unlikely that SoFi is going to dramatically disrupt what is otherwise a super competitive marketplace. For like, hey, you don't go to the lender just because you like them, generally. You go to whoever gives you the best rate on your home loan. And people are going to do the same thing for their personal loan if they shop it around. So it's going to be hard to disrupt all these products in their lending market and get that growth. And particularly if you're looking at a commodity market, the reason why the incumbents have succeeded, you get the Wells Fargo, the Citigroups, the Bank of Americas that have done so well over time, the JP Morgans, is because they have a cost advantage, particularly the biggest ones like Wells Fargo, relative to everyone else. And that cost advantage is through having this really low cost deposit base where people just go in and they go, well, I don't know what to do with my money. And they go into a branch and they go, here's my money, sit on it. You effectively pay me nothing and I'm going to twiddle my thumbs. And Wells Fargo, meanwhile, goes, thank you very much. Let's go make a loan. And they make a nice spread off of that. And part of that is because people trust Wells Fargo to not go belly up, during the next time there's a financial crisis. And there might be an element to that as well with SoFi of like, hey, if they're keeping their loans on their balance sheet, do they have enough liquidity and things like that? At this point, they probably do. But it does, Wells Fargo was an anti-fragile company in the financial crisis because people actually put more of their deposits in Wells Fargo because they trusted them to weather the storm. So that is a tough, competitive advantage to sort of overcome when you're looking at these various different players. So it'll be years before they have a comparable cost advantage where they could even write loans at a similar cost is what I would expect. Maybe they could offset it with their cross-selling potentially, but it's from a cost perspective of the interest rate that it would cost them, they aren't going to be able to match that, for years. So that's the first thought. The next thought is, let's actually look at their growth rates because people are hyped up, hyper growth Chamath company. Let's actually think about it a little bit, peel it back a little bit. So their lending revenue increased by about 87% in 2019. That's from a different slide. And that's presumably based on a different slide. So super fast growth in 2019. But then as you look in 2020, their lending business only grew by 16% versus a 38% forecast for 38% growth forecast in 2021. So I would want to know more details on what's actually going on here, that this growth rate decelerated so much. And how do investors that are bidding up the stock have so much confidence that it's going to accelerate not only in 2021 but into the years ahead? On that note, let's look at Galileo because a big part of their growth in 2020 and 2021 is from their technology platform where effectively you had 100x growth in 2020 and then in 2021 you have 100% growth. That's a key contributor of the growth rate that you're penciling out this year and next year. So while it's only mentioned very briefly, they actually acquired Galileo in May 2020. So this drove, per the, I think this is the CFO's comments, this drove 50% of the year-over-year improvement in both the top and bottom line. Hold on a second. So this isn't really their organic growth. This is their acquired growth of what they're looking at. So this whole hey, going from 450 to 621, that's because they acquired Galileo. On that note, if we assume that 90% of the tech platform revenue is from Galileo, because they do have this Apex clearinghouse, but they've indicated that Galileo is the vast majority of it, that implies their 2020 growth was really 17% on a consolidated basis versus their consolidated revenue growth of 38%. So, I'm looking at this and I'm not crazy excited about it. I'm okay, you acquired a company and that's the reason why you posted 38% growth. Outside of acquiring them, your growth was actually pretty not that great, especially for a stock where people bump it up. As a new acquisition, it's a new business. So you do have sort of look, you're bringing in new culture into another organization. Does it all fit well? Are people going to be working together well? There's a whole different CEO that runs their Galileo segment. And the whole argument that Chamath is making that it's oh, yeah, this is just like the AWS of finance because they're taking this cost center and making a business segment. I mean, that's ultimately flawed because, like, first of all, that argument is only true if Galileo is what they were using to power their lending segment pre-acquiring Galileo. I would say a more relevant comparison would be like, oh yeah, it's just like when Amazon realized they needed an infrastructure solution and they acquired a company that turned into AWS. But that's not what happened. They realized this was an organic process versus an M&A process for Amazon. So for them to say like, oh yeah, it's a cost center that's turning into profit and they figured that out and that's the reason why no. Galileo is very different. They figured, hey, this is purely business to business. Unless, SoFi was like, oh, we're using them, why not acquire them and then we'll get a view into these other customers. But this actually creates a very conflicting view that, in my opinion, hasn't even played out yet because they've only owned Galileo for a few months at this point. So let's go into this sort of conflicting view. Let's look at Chamath's own words. Then the last thing, if we really wanted to see a winner take most outcome, was trying to evaluate this was him talking about like the best opportunities that they were going through, was built on a modern technology stack such that, very similar to Amazon, a company in fintech could use the consumer business as a Trojan horse to also build a best-in-class enterprise business. In this case, what we would call an AWS of fintech. Dude, really? You just said it's a Trojan horse. Like, while this comment might be right now, longer term saying something like that is self-defeating. What do I mean? So Robinhood is one of the customers that they're calling out. Like, hey, Robinhood is one of the business-to-business customers. You can see a bunch of the others, Chime, Bluevine, Monzo, Aspiration, that are using their Galileo technology platform to power them. It is a critical part of their infrastructure. Don't get me wrong. But here it is. This is the CEO later on talking about what SoFi is planning on doing with their financial services products. I want to talk about one process we went through to architect our Invest product to show you this as an example. We looked across the landscape of offerings as it related to brokerage or investment products. It was clear to me that no one place was offering all the asset classes that are of interest to our members, who we also surveyed. So we launched SoFi Invest with the ability to buy single stocks without commissions, ETFs of our own brand to help with diversification, and better access because they had no loads. We also had lower price points with those ETFs. We also launched robo-advisor accounts and cryptocurrency on one platform. Still today, we're the only company that's offering all four of those asset classes and their self-branded ETFs. Since we've launched, we've then added fractional shares, which we pioneered, recurring platform, recurring investments, and we're on our way to introduce portfolios for those that you're following socially on our platform. We will continuously iterate over and over and learn to drive innovation. Wait a second. SoFi has made the point that they are targeting the juiciest customers out there. They're saying these are the high-income customers, generally on the younger side, so it's creating a great lifetime value for their customers. Do you really think Robinhood will want to invest with this partnership longer term? If here it is, in one pocket, yeah, Galileo is helping them out, but in the other part of the house, it's like, oh yeah, we're taking our technology and launching competitor products that are looking to take the best players in the marketplace. These high-end, these high-income consumers that could be partners on our platform for life. So do you think Robinhood's really going to want to stay with Galileo long-term? Do you think this creates the win-win dynamic that they need? Or do you think they're going to say, oh, shoot, we need to start taking this in-house. We need to take all of our money and put in R&D to make sure we bring this in-house because we can't rely on them because they're going to try to eat our lunch with their own SoFi products. It's sort of like, hey, I'm a Trojan horse. Nothing to see here. Huh? So I sort of think like, hey, saying you're a Trojan horse when you're a Trojan horse, it's a really bad idea. It only works if you don't tell people that you're a freaking Trojan horse. Anywho, imagine if they went in Troy and it's like, yes, here's our gift to you. There's a bunch of men inside here. So don't make sure you don't heat it up. Otherwise, I think Odysseus will get a little smoked out. Like, you don't tell people that you're a freaking Trojan horse when that's exactly what they are. So longer term creates a real problem for their growth prospects, in my opinion. So what am I going to do as I look at this? At the current valuation, given that it's been bid up so much, people are super excited. Another Chamath deal, a big Chamath deal, hyper growth that's not actually so hyper. Hypesters are just paying for a business that they're excited about. SoFi sounds cool, fintech. And in reality, it grew organically less than 20% in 2020. I'd like to see them execute more in 2021 and the years ahead before I'd be willing to pay up for it. Also, as you can get my reservations. You saw sort of the exclusive content that I would normally share just exclusively for Journey subscribers. Here it is. I shared sort of my additional thoughts as a gesture of goodwill to the YouTube subscribers that are interested in learning more about Journey, in terms of the additional take that I bring. At the end of the day, part of the reason why I'm not crazy excited about it is because my January 2021 potential multi-bagger that I bought for myself and I called out for my Journey subscribers, it's growing multiples faster than SoFi. It's a consumer finance product and it trades at a dramatic valuation discount. And I'd argue better profitability currently than what they're looking at. So I'm looking at this and SoFi's 100% upside, maybe, if they execute, and everyone's like, yes! Now, of course, it can go higher just based on hype. Versus, the stock that I called out, for Journey subscribers, my January, potential multi-bagger pick, where I'm like, yeah, I think there's potential 800% upside here. And it smells right to me. So, but that's sort of the value proposition that I'm bringing with Unrivaled Investing Journey. And if you want to learn more about unrivaledinvesting.com, you go to unrivaledinvesting.com, click on Journey. You can see, all this sort of exclusive content. It's not only what I buy, what I sell, what I hold. I create an educational series for people to learn from, how to value stocks, how to find potential multi-baggers, how to think about margins long term. The catalog of everything I've done that's part of this exclusive journey, I'll put a link below in the description of this video so you can click on that as well. That's in addition to all the YouTube videos, so that way you can go through the names like Roblox or whatever. I've done a video on that, or Clover. And look, it's a journey. That's the reason why I called it that, because I'm not looking for a quick day trade. I'm not going to be updating you every day. Oh yeah, this is what I'm buying, selling, buying. No, I'm trying to find multi-baggers, companies that I can sit on for long periods of time and then just sit on them and ride it out as they deliver exceptional growth long term. And so it's about a couple of updates where I'm sharing, hey, here's this company that I'm buying for myself, or I think has potential multi-bagger upside, and maybe it's right for your journey. You can check it out for yourself. And the reality is, just finding one potential multi-bagger can change your life journey. So if you're interested in following my journey to try to find these potential multi-baggers, go to unrivaledinvesting.com, click on Journey. And if you enjoyed this video learning about SoFi IPOE stock, oh my goodness, pump it up, said the Trojan Horse. Then make sure you subscribe. If you're already a subscriber, I appreciate that thumbs up. It really does help, I think, getting the video proliferation out there so people can learn about it. And thank you so much for watching.